So in the last video, we dived a little bit more into the hedging aspect about what exactly is a hedge. And it's somebody who's trying to transfer risk, or they're trying to forward price their commodity. And then we talked a little bit about hedging costs. Well, the primary costs for hedging are going to be either commissions or margins. So commissions are paid to the broker to cover aspects such as administrative costs. So these commissions, or these brokerage fees, is another term for it. So these commissions are going to be used to pay to the broker to cover the administration costs, futures exchange operation, futures exchange regulations, things like that. These commissions, they can actually range from about $9 to more than $35 per order. The key aspect right there is per order. So an order is actually in order to either buy or sell a contract. So whenever you engage in a futures contract, let's say you long the market, so you go ahead and engage in a contract where you agree to buy a commodity, well, you have to sell it back, and you have to offset that contract by selling it back. Well, whenever you do that, you're actually placing two different orders. An order to buy that commodity and an order to sell that, or to buy that contract and sell that contract. So these commissions, it actually can range anywhere from $18 to $70 per contract, or per hedge, I guess you could say, per hedge. So there is also another cost associated with hedging other than just what you can make or lose in the futures market. So the next component are these margins. So these margin money is paid only in the futures. They're not options. So options, you have the premiums, but here, whenever you're dealing with the futures contract, you're paying margins. So the initial margin. The initial margin is the earnest money that is placed in the brokerage account to cover potential losses, and that is required to start trading. So whenever you engage in a futures contract, the prices can go up and the prices can go down. There's no limit, there's no ceiling, and there's no floor to those prices. So essentially, you could, if you placed let's say that you placed a long, or you longed the futures, so you bought into those futures, and the price begins to fall. Well, the value of your contract is falling. It's going down, and they want to make sure that you have enough money to cover those potential losses on that futures contract. That's known as that initial margin. You have to place a certain amount in this brokerage account to cover for these potential losses. And then you have what's known as a maintenance margin. So a maintenance margin is a set level below which the initial margin cannot drop. So let's say that they require an initial margin of maybe $1,000 or something like that. But then they set this maintenance margin at $250. So if your contract begins to lose money, or that hedge that you've placed, or that position that you're holding in that option or in that futures market begins to lose money, and you actually lose $750, and now you're hitting this maintenance margin, that's the bottom line that it can go into that brokerage account. So it's used to maintain a certain level in that brokerage account. If that margin falls below this maintenance margin, a margin call is performed. So the last terminology in these margin aspects is this margin call. A margin call is a signal that the contract holder must add funds to the account. So let's say you initially put in $1,000, your fund begins to lose money, or that position that you're holding is losing money. It's lost $750. It hits that margin maintenance margin at $250. Then you receive a margin call. That margin call says you must replenish that brokerage account and put more into that account. So an interesting thing to note between a futures contract and an options contract is a futures contract, there's no limit to how much you can lose. You can lose the whole value of that futures contract. Whereas in an options contract, the absolute most that you can lose is that option premium. So that option contract is often considered less risky because the most you can lose is that option premium. Whereas in a futures contract, you can lose the whole value of the commodity if prices continue to drop. So The next thing I'd like to talk about is this information and future price movements. So we have a couple of different terminologies. We have a couple of different terms to talk about. We have fundamental analysis, symmetric information, asymmetric information, and then this technical analysis. So this fundamental analysis is when we use the use of market and commodity information to predict future prices or to predict future price direction. So fundamental analysis is where we're going to take reports maybe from the USDA talking about the commodity information. How good is the commodity? Are certain areas getting more rain than the other? Are certain areas drier than the other? How is supply predicted to come out? What is the quality of that commodity supposed to come out of these different areas? And then also we're going to use previous market information. What were the prices last year? What were the prices, the running average over the past 5 years, or things of that nature, to try to predict these price movements or this future price direction. That's that fundamental analysis where we're actually going to take data to try and determine that. And then we have symmetric information. So symmetric information is the general availability of information to all market participants. So symmetric information is going to be those USDA reports. That's going to be that market information, that market data. And that information is generally available to all market participants. So anybody can obtain this information. Whereas analysis is using that information to predict the future price direction. Symmetric information is that general availability of that information to all these market participants. Then we get into asymmetric information. So the market participants are going to use this fundamental analysis, and they're going to use this symmetric information, but they're going to interpret the information in different ways. So somebody may look at a USDA report and say, well, I think that, like Bill said, is that prices are underestimated. So I'm going to interpret that data that way. But then you have Tom who says, oh, they're overestimated. So we have two different people, two different market participants. They're interpreting this information in different ways, leading them to do what they believe is best. And in that case, Bill thought prices were going to actually, he said that supply was underestimated. So he thought prices were, was underestimated. So he thought prices were going to drop. Where Tom, he believed prices were overestimated, or supply was overestimated, and that prices were actually going to rise. So they're interpreting that information in different ways. That's asymmetric information. And then we get down to this technical analysis. Technical analysis is the charting of trends in current and historical prices and trading patterns to predict future price direction. Whereas this fundamental analysis, it's typically using, I mentioned that it's going to use the market prices. It's not really using the market prices so much, but it is going to be using market and commodity information. What is the supply that's currently out there? What's the quality of that information? Usually those reports are coming out from like the USDA or private companies, things of that nature. Whereas technical analysis is actually looking more at the historical and the current prices of that particular commodity. We're gonna plot those patterns. We're going to look at those trading patterns, and we're going to try and predict that future price direction.